Hello there. So, you've just sold an asset, maybe a property or some shares, and now you're staring down the barrel of a pretty hefty capital gains tax bill. If that's you, you are in the perfect place. We're about to walk through a really powerful government-approved strategy to help you deal with that exact problem. Let's get right into it.
Now, all of this has been put together by the absolute experts at My Tax Accountant. Honestly, these guys live and breathe this stuff every single day. So you can be sure that what you're about to hear is clear, it's accurate, and it's all designed to help you make much smarter choices with your money.
All right, let's cut to the chase. Does this sound like you? You've put in the hard work, you've made some savvy investments, and now you've cashed in on something big, a rental property, maybe your share portfolio, or perhaps even the business you built from scratch. The profit feels great, right? But there's that nagging thought in the back of your mind about the tax bill that's on its way.
To make this real, let's just look at a number. Say you made a £200,000 gain on a residential property. Well, if you're a higher rate taxpayer, you could be looking at a tax bill of £56,000. Just think about that. That's a huge chunk of your profit going straight to HMRC. But what if you could just hit pause on that payment?
To really see how this works, let's use a real-world example. I want you to meet Sarah. She's a brilliant freelance graphic designer living in London. She's done incredibly well for herself, and years ago, she invested in a rental property. She just sold it to raise cash for her next big project.
So, Sarah made an amazing profit of £500,000. Fantastic news, but that success comes with a massive sting in the tail. Because it was a residential property, she's hit with the higher rate of capital gains tax. Her bill? A jaw-dropping £140,000. Ouch! That is a serious dent in her future plans, and that is the problem we're here to talk about.
And here it is. Here's the solution. It's called the Enterprise Investment Scheme, or EIS for short. Honestly, the easiest way to think about the part we're focusing on, CGT Deferral Relief, is like hitting the snooze button on your alarm. You're not making the tax bill disappear forever, but you are strategically pushing it off into the future. So what does that actually mean? Well, at its heart, this is a government incentive. It was created to encourage people like you and me to invest in smaller, growing UK companies. The deal is this. If you take your capital gain and reinvest it into one of these eligible businesses, HMRC says, okay, you can put off paying the tax on that gain. Okay, the idea of hitting snooze on a massive tax bill sounds amazing, right? But how does it actually work? What are the rules of the game? Because, it's not quite as simple as just picking any old company to invest in. There are specific rules you absolutely have to follow.
Here's the key thing to get your head around. The government wants this money to go into genuine, up-and-coming UK businesses. That's why the rules are there. The company you invest in can't be on the main stock market, it needs to have fewer than 250 full-time employees, and its gross assets can't be more than 15 million quid before you invest. And, this is a big one, to prove it's a real long-term investment, you've got to hold on to those shares for at least 3 years.
And this, for me, is one of the most brilliant parts of the whole scheme. The timing is so flexible. You get this massive 4-year window to play with. You can actually make your investment up to a year before you even sell your asset. Or you can wait and invest up to 3 years after the sale. It just gives you so much breathing room to find the right company and get your finances sorted without any mad rush.
Okay, you might be thinking, what about all the paperwork? Well, you'll be happy to know it's actually pretty straightforward. Step 1, you make your investment in a qualifying company. Step 2, after the shares are issued, the company sends you a really important piece of paper called an EIS 3 certificate. And Step 3, you just fill out the claim form that comes with it and pop it in with your self-assessment tax return. That's it. Okay, now this is where it gets really, really powerful. Deferring your capital gains tax is just the start. Seriously. Stay with me on this next part, because understanding this is how you go from just delaying a tax bill to potentially getting a massive tax saving. You see, the Enterprise Investment Scheme is like a Swiss Army knife of tax relief. It's built on 4 main pillars. We've talked about number 1, the CGT Deferral, but there's also a massive 30% upfront income tax relief. On top of that, if your new shares go up in value and you hold them for 3 years, any growth is completely free of capital gains tax. And to top it all off, after 2 years, the shares can also become exempt from inheritance tax. It's an incredible package.
And here's a little pro tip for you, a nugget of info that a lot of people miss. While all these reliefs work together beautifully, they're not all tied at the hip.
You can still claim the capital gains tax deferral relief, even if, for some reason, you don't claim or don't qualify for the 30% income tax relief. It's a really useful bit of flexibility built into the system.
Right, let's go back to Sarah and see what this means for her. This is the real wow moment. Without EIS, she's got that $140,000 bill. But if she reinvests her £500,000 gain into an EIS company, look what happens. Her immediate CGT bill drops to zero. But that's not all. She also gets 30% income tax relief on her investment, which is $150,000. So she hasn't just kicked a £140,000 bill down the road, she's actually got an immediate tax saving of £150,000 in her pocket. The transformation is just staggering.
Now, I know this all sounds almost too good to be true, but these incredibly generous tax breaks exist for a very good reason. An EIS investment isn't like popping your money into a high street savings account. That's not all. Here's where most people go wrong. It is absolutely crucial to understand the risks involved before you even think about putting your money in.
Okay, let's be really clear about this. First and foremost, you're investing in small, unlisted companies. They are, by their very nature, higher risk. There's a very real possibility they could fail, and you could lose your money. Remember, you have to hold the shares for 3 years to keep the tax reliefs, and the company has to stay EIS qualified that whole time. Also, be aware, if you move out of the UK within those 3 years, that tax bill you deferred can suddenly become due. And finally, of course, the government can always change the tax rules.
So, there we have it. We've looked at the problem, we've explored the really powerful solution, and we've been honest about the risks you need to consider. So, what next? How do you take all this information and turn it into a solid plan?
You know, don't just take it from me. The Enterprise Investment Scheme Association itself, the official body, is crystal clear on this. Given how complex this can be and the risks involved, getting professional advice isn't just a good idea, it's pretty much essential to get it right. And that brings us to a really important point. Everything we've talked about today is for general guidance. Think of it as a great starting point to get to thinking, but it is absolutely not a substitute for professional advice that's tailored to you and your specific financial situation.
Before you make any big decisions, you really must speak to the experts. The team at My Tax Account can help you navigate everything we've discussed, the CGT deferral, all the other EIS benefits, and any other tax worries you might have. They'll look at your specific circumstances and help you figure out the best strategy for you. Give them a call on 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk.
So, we'll leave you with this question. Getting a large capital gain is both a challenge and a massive opportunity. With the right strategy and the right expert help, you can deal with the tax bill and potentially turn it into a brand new tax-efficient investment for your future. So the only question left is, are you ready to make your capital gains work a whole lot smarter?